Hello everyone, and welcome to an economics markets briefing by ACY Securities. I'm Clifford Bennett, Chief Economist. We're continuing to see some upward pressure in the Australian share market on the day, and that is in response to the balance of trade data, which showed near record or record trade surplus for Australia, and the market certainly celebrated that to some degree. Overall though, in the markets in the US overnight, we did see new highs, but hesitation. Crawling up, hesitation. It's not a really convincing sort of new high situation in the US at the moment. In Australia, we saw that move higher that really kicked off with the RBA saying expect a quick recovery out of the current lockdown period. And that there'd only be a 1 quarter, sort of negative growth period. I think we're going to have a recession. I think lockdowns are a risk, and I've highlighted all along, of being extended further. And there is the risk of a whole eastern seaboard lockdown in terms of Queensland, New South Wales, Victoria. Let's hope that doesn't happen, but certainly that is a risk people should not be discounting in the way they seem to be at the moment. So just looking at that data, the Australian balance of trade, a very big number there, 10.5 billion in June. Now, why did Australia achieve that? It isn't because we have a strong economy. I know, the share market's celebrating. You should be celebrating, I guess, in the miners and the bankers, the world's bankers to the miners, some of the Australian banks. But it isn't because of a strong Australian economy. If we look at imports, we can see here that imports have recovered, but to nowhere near their 2019 levels. Now that's for two reasons. One, supply chain disruption, shipping disruption, but it's also partly due to, and this is the part that I think too many economists are discounting, partly due to the Australian economy simply isn't running at quite the same level that it was before, even though it appears to be doing so in the aggregate data. I've spoken at length about that before, and there's an interesting article I've written today that will be on the acy.com website that could well be worth a read as well, along those kind of lines. But I did want to show you the breakdown of the record trade surplus is much lower imports. Even though they're up for the month, they're still at low levels, much lower imports. Whereas when we look at exports, they are at around almost at 2019 levels. And given that, this is really about the export of minerals and agricultural products, those two sectors need to be applauded as world's best practice at what they do. They should be very, very happy with themselves indeed. But that demand is driven from offshore. It's not demand driven from within Australia. So great trade surplus number, great exports, not so great really an indication of the domestic economy. So we'll have a look at the Australian dollar, which is where you'd expect some real immediate impact of that kind of data. And it remains extremely heavy now for about 2 weeks, consolidation here. And continues to really risk moving to the downside. Big downtrend, we called it up here, 77.45 up here, we said it's going to 70 cents. A lot of people are saying 70 cents now. Well, it's only around the corner, not such a big call. It was certainly a big call back up there. And I've been saying, yesterday you'll remember I said 74.25 was the key level. Well, the Australian dollar topped out at 74.26. So I think we did okay on that. But anyway, that's a level to continue to keep an eye on. But the Australian dollar hasn't really got much of a boost, slight improvement, but not much of a boost from that trade surplus number today. When we look at the Australian share market, every day I'm warning it could be a top, and every day it edges higher. So this steady climb over this last week, but not, it's just, I guess, gains are gains. And that's why I said I've got it wrong. But I just really want to keep suggesting caution. When we move in on the hourly, you can see that we've had a bit of a break higher here on the back of the trade number. So the share market's responded more to the trade surplus number than the currency has. which really shows that it's a sentiment, an excuse to buy in the share market rather than fundamentally driven, although of course aspects of that are the mining stocks. So we've had a boost, but then just hesitation again for the last few hours, last couple of hours, and it's the sort of price action we've seen all along for the Australian market. It has a bit of a rally and then it just falls back, has a marginal new high, falls back, marginal new high, could be falling back again or kicking on. I tend to think though, when you look at the US market, this is the Dow Jones now, again, 2 weeks hesitation here at these highs. Not really kicking on. The Dow Jones chart looks really a little bit vulnerable here. If it were to move below sort of 34,700, it could be a market in big trouble. The bulls maintain an argument, but it's just not a good look at the moment. It's just not convincing. When we look at the NASDAQ's struggling up here. It's taken a week to come back, over a week, to come back towards that previous record high. And it looks tired already. I mean, while 15,000 holds, and I think 15,000 is going to become quite an important psychological level now. Everyone in the market's going to start talking 15,000 soon as a pivot point. While we're above 15,000, it's a bull market. We don't want to see it fall back below, that sort of thing. So the bulls definitely have an argument above 15,000. Will it stay above 15,000? Between 15,000 and sort of, you know, getting up there around 16,100, that range is very random at the moment, but it's just this lack of momentum. It's like this, it's really hard work for the market to make new highs now. Looking at, we'll move on to commodities, just with stocks, I really would refer you to the article I wrote today, sort of a major economic and market matrix review that is on the website, what not to do on the day. You might be amused by that angle of it, but just moving on now to gold. So daily gold chart, it's just several weeks sideways, but this market has a bullish bias. It really does. After testing the lows, been twice rejected, I think the market could be volatile in this broad range here, sort of 1789, 1829, but I tend to think we're going to hold above sort of 1804, 1805 to kick on. It's a little bit of a brave call on the day in terms of very immediate support, but it would be nice to see it back above 1815, 1816, and you've got a very solid formation there for a continuation of a major uptrend. I've been saying we like gold for quite some time now, since that double spike rejection low over there, and I think gold could be the real hedge against inflation and a resurgence of Delta, and now out of Peru, another variant, which is even more vaccine resistant, unfortunately. But vaccines aren't going to stop. There's going to be a second generation Pfizer, a second generation Astra. So there's certainly hope on that front. The US situation is a little bit worrying. I mean, they're actually talking about some hospitals in the US running out of oxygen, which was unheard of. And hospitalisations are higher than in the first wave. And the tragedy in Indonesia just continues to unfold terribly. So gold could be a hedge against all that kind of ongoing rolling uncertainty that people thought was behind them, and the outlook was nothing but blue skies. We might be in this situation for 2 to 3 years yet of these occasional outbreaks and rolling disruptions to supply chains. So in that kind of environment, and I've spoken at length about how I think people out of fear have been buying US stocks from other parts of the world as a safe haven investment, I think that energy, if you like, could shift a little bit more to gold, and we could see gold just sort of stabilize here and then start to kick up in a big way. Oil, we've called oil very well, near the, at a reasonable level up here. We were talking about oil could have a crash, and it did, but I didn't just say it would have a momentary crash. I said this is going to be a long-term top for gold, and after that good attempt to get back into that previous, I actually think the topping out formation was here. The market's broken down, and then it's tried to get back into that previous range, but it just can't sustain it. That's a very sort of bearish outcome for the market, and I think oil can still be volatile here, as we've seen previously, but I think oil is going to turn into a reasonably sustained, steady downtrend within a month or two, and perhaps even sooner than that. That's all I've got for you today. I hope that helps. And don't forget, at acy.com, we try to say it first because we try to add real value to your own method and approach to your own trading and investment portfolio structures. Thank you very much. All the very best.